I think this model through, we are in till the end of 24, because 24 is an ultra long year with the elections. So expect choppiness and the rough sea for at least the next 12 months. I'm really serious about this. It's very normal in a pre-election period in the States, and I know we can say that pre-election has not started yet, but you see, and we are in this tail of the financial cycle somehow, to see these ups and downs, this half of the sectors, something that looks like a recession and something that doesn't look like a recession. So I think we're going to get a lot of volatility. What is interesting is what policymakers do of this volatility. And you see the same volatility from policymakers that intensifies the volatility. Monetary policy, we're data dependent, which means, we're going to see and we're going to, skip and hike and skip again. Fiscal, you know what, we have IRA, but we want to be fiscally responsible, so we may think about taxes again. This is the type of volatility, structural volatility we're looking to, and I think it's not gone. For me, I'm still on the data you just mentioned, the jobs reports, the PMI and so forth. I'm still very concerned about the lending of the US. I think this call for soft lending is understandable. I still see very weak growth going ahead as consumption is actually waning off. So I want to see how the lending actually is managed, this soft lending.
Ludovic, investing alongside these conditions are very difficult, and you've written a whole piece on diversification. I think this is fascinating, questioning the 60-40 split and whether it continues for here, private assets, but also diversification internationally and by sector. Just run us through the theory here as to how you place the bets to ensure you're diversified to protect against any downside risk.
The idea is that 22 was really a pivotal year for market operators. It's one in a 30-year event. There was nowhere to hide. And 23 was supposed to be the return of diversification, but this policy uncertainty on the monetary side, and therefore these inflation surprises, but also this entropy, these narrow markets on the equity side, really question us about, okay, is there diversification again or not? And then we looked, we basically run a few models, and we still see a diversification dividend, but it has changed a little bit. It has changed in terms of your investment strategy. That's why we call for private markets being an alternative for this hold to maturity type of investors and this long-term creation of value. We look at sector diversification on the equity market, but also, how the bond market diversification has completely changed. Imagine the number of issuers. The size of the issuance from developed market compared to emerging markets because of the COVID response, right? So there's been these dislocations, if you will, that has changed a bit diversification. So diversification is not dead, but it has evolved a little bit. And so we see some regime switch in some of the correlation between assets. And especially, of course, the most significant one is the bond to equity correlation. So, the idea is to say, okay, play it a bit differently, try not to bet everything on diversification. And more importantly, try to think about a diversification that is structurally, tweaked by fragmentation on the geographical side and industrial policy on the sectoral side. So the macro effects are really shifting the cards of diversification the way we used to. So politics, climate, fragmentation is really driving markets a lot and therefore driving diversification a lot.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.